Let me ask you something. Imagine you have $10,000 sitting in your bank account right now. It's just sitting there. You worked hard for it. You saved it. And every single month, your bank sends you a little notification, a reward for being responsible. 37 cents. That's it. 37 cents in interest for an entire month of letting the bank hold 10,000 of your dollars. Now, here's what's wild. That same bank, it's taking your $10,000 and lending it out to someone else at 7, 8, maybe 9% interest. Your money is out there working, just not for you. And most people don't even realize this is happening. But then someone tells you about something called a high-yield savings account. Suddenly, you're seeing 5%, maybe even 5.5%. You think, finally, this is the secret. This is how money actually grows. This is what rich people must be doing. So you move your money. You feel smart. You feel like you've leveled up. And in some ways, you have. But there's a hidden truth about high-yield savings accounts that almost nobody talks about. And by the end of this video, the way you think about saving money will never be quite the same again. Here's the thing about human psychology and money. We are wired to love visible progress. When we see a number go up, even slightly, our brain releases a little hit of dopamine. It feels good. It feels like winning. And that's exactly why the jump from a traditional savings account to a high-yield savings account feels so satisfying. You went from earning almost nothing to suddenly watching your balance grow in a way you can actually see. Your friend tells you about it, you Google it, you see rates like 5% and your jaw drops. You compare that to the 0.01% your regular bank has been quietly offering you for the past 3 years, and you feel almost angry, cheated even. And so people do what feels logical. They park their emergency fund there, then their short-term savings, then their I'm not sure what to do with this money. Everything just goes into the high-yield savings account. Because 5% sounds like a lot, especially compared to almost nothing. But here's where the hidden truth starts to reveal itself. The problem isn't that high-yield savings accounts are bad. They're actually genuinely useful. The problem is what people believe they are and what they quietly give up while chasing that interest rate. Let's break this down slowly, because it's actually a really simple idea once you see it clearly. A high-yield savings account, or HYSA as people call it, is basically a savings account offered usually by online banks. Because these banks don't have physical branches to maintain, they pass some of those savings on to you in the form of higher interest rates. That's why the rates are better. It's not magic, it's just a different business model. And the interest you earn, it compounds, meaning you earn interest on your interest, month after month. Your money slowly snowballs. So let's do some real numbers. Say you put $20,000 into a high-yield savings account earning 5% annually. After 1 year, you'd have made roughly $1,000 in interest. That's not nothing. That's a free flight. That's a month of groceries. That's meaningful. Compare that to a regular savings account at 0.01%, you'd have made $2. $2 on 20,000. That's genuinely depressing. So yes, high-yield savings accounts are clearly better than traditional savings accounts, by a mile. But now, here's the question nobody asks out loud. Better than a traditional savings account compared to what else? Because 5% sounds impressive until you zoom out and look at the full picture of what money can actually do. The S&P 500, which is basically a basket of the 500 biggest companies in America, has returned an average of roughly 10% per year over the last several decades. Not every year. Some years it's down, some years it's way up, but averaged out over time, 10% has been the historical trend. So if 5% is good, 10% is twice as good. That's not a small difference. That's the difference between your money doubling in about 14 years versus doubling in about 7. Now, before anyone panics, I'm not saying high-yield savings accounts are useless, not even close. But I want you to understand something important about how these accounts get used versus how they should be used. There's a psychological trap that catches a lot of smart, well-meaning people. It's called the feeling of being responsible. When you put money in a high-yield savings account, you feel responsible. You feel like you're doing the right thing. The money is safe, it's growing, it's liquid, meaning you can access it anytime. There's no risk, no volatility, no scary headlines to worry about. And that feeling of safety is genuinely comforting, especially in a world where the stock market can drop 20% in few months and headlines are screaming about recession and uncertainty. But here's the psychological insight that changes everything. Comfort has a cost. When you keep large amounts of money in a savings account, even a high yield one, because it feels safe, what you're really doing is trading long-term growth for short-term peace of mind. And sometimes that's the right trade, but most people make that trade without ever consciously choosing it. They just drift into it because it feels good. There's actually a name for this in behavioral economics. It's related to what researchers call loss aversion, our tendency to fear losing money more than we enjoy gaining the same amount. Studies have shown that losing $100 feels roughly twice as painful as gaining $100 feels good. So we avoid anything that looks like it could result in a loss, even when the math clearly says we should accept some risk for significantly better long-term returns. A high-yield savings account becomes the perfect hiding place for loss-averse brains. It's growing, it's safe, what's not to love? What's not to love is what economists call opportunity cost. The price you pay isn't money leaving your account, it's the money that never arrives because your capital was sitting in the wrong place. Here's a simple way to think about it. Imagine you have a store with 100 employees. You want all 100 of them working and generating revenue, but a portion of them, let's say 30, are just sitting in a back room. They're not causing trouble, they're comfortable, they're earning a small hourly wage just for existing, but they're not out there doing what they were hired to do. That's what happens when you over-rely on a high-yield savings account. Part of your financial workforce is benched. So what's the actual hidden truth? It's this. A high-yield savings account is an excellent short-term tool that often gets used as a long-term strategy. And that one mistake quietly costs people tens of thousands of dollars over a lifetime, sometimes hundreds of thousands, without them ever seeing it happen. Here's how the misuse typically plays out. Someone learns about HYSAs, they move their emergency fund there, which is smart, that's exactly right, but then they also move their house down payment savings there, their future investment money, their bonus they're not sure what to do with, their inheritance, their everything. Because it feels smart, it feels like a step up, and compared to a regular savings account, it is. But the people who actually build wealth over decades, they use savings accounts as a waiting room, not a destination. The money sits in the HYSA only long enough to figure out where it's truly going. An emergency fund lives there permanently, 3 to 6 months of expenses, liquid and accessible. That part makes complete sense. But money earmarked for goals that are 5, 10, 20 years away, that money has a much more powerful place to be. And the real tragedy is that the 5% interest rate actually creates a false sense of progress. It makes the account feel productive, so people stop asking whether the money could be doing more. The dopamine from watching the balance grow keeps them comfortable, and comfortable is the enemy of optimal. So what do you actually do with this information? Think of your money in 3 distinct buckets. The first bucket is your safety net, your emergency fund. 3 to 6 months of living expenses. This absolutely belongs in a high-yield savings account. It needs to be accessible, it needs to be stable. A HYSA is perfect here, no debate. The second bucket is your short-term goals, money you'll need within the next 1 to 3 years, a vacation you're saving for, a car, a down payment on a home in the near future. This money also makes sense in a HYSA. You can't afford to have it exposed to market volatility when you'll need it soon. Keep it safe, let it earn what it can. The third bucket is your long-term wealth, money you won't need for 5, 10, 20 years or more. This money does not belong in a savings account. This is the money that should be invested in index funds, in retirement accounts, in assets that have historically compounded at rates that make 5% look like a warm-up. The difference between someone who builds real wealth and someone who just feels financially responsible often comes down to understanding this third bucket and actually using it. Because time is the most powerful ingredient in wealth building, not the interest rate on your savings account, not the size of your paycheck, time. And every year you let long-term money sit in a HYSA instead of compounding in the market is a year you can never get back. So here's the thought I want to leave you with. High-yield savings accounts are not the villain in this story. They are genuinely useful. They are clearly better than letting your money sit idle earning almost nothing. If you don't have one yet, you should probably get one. But the hidden truth is that 5% can become a ceiling if you let it. It can become a comfortable plateau that stops you from asking the bigger question, which is not how do I earn more on my savings, but how do I stop treating invested money like savings at all? The goal of a savings account is not to build wealth. The goal of a savings account is to hold money safely until you know what to do with it and to protect the money you truly cannot afford to lose. Everything else, everything that can be patient, everything that has time on its side, that money deserves a bigger mission. Because here's what nobody tells you when you open that shiny new high-yield account and watch your first month of interest hit. The bank offering you 5%, they're investing your deposit and earning significantly more. They always have been. Maybe it's time your long-term money started doing the same thing just for you.